My name is Jean Stellman. I'm the president of EPIC. I'm really delighted that we've had such a really good response to this talk. And in fact, it was so many people registered on Zoom that we decided not to have have it be hybrid, that it was just much easier technically for us all to be on Zoom than to have it be a hybrid. Having said that, next week we're going back. We will be in hybrid, and I don't see Lynn is on there. Lynn is on my screen. Lynn Segalin is going to talk to us about her wonderful new book on Times Square, on remaking Times Square, and she spoke to us a few years ago on her downtown Manhattan work, and she's a fabulous speaker. So I really urge you, as many of you, either to come in person or to be online for her talk next Tuesday. As you can see in our new newsletter, we're starting off with a new drama, the Epic Drama Society, where we're going to do play reading. So if you're interested, send in a form, and Connie Nathanson and Abdallah will get back to you, and we'll see where that's going. We're going to reactivate our music initiative, and I'm hoping that someone will volunteer to get some walking groups organized, because that's healthy and fun as well. So having said that, we look forward to seeing you at other things, but today we have the pleasure of having Tamara Telesko, who is the Director of Wealth Planning Strategies at TIAA, speak to us about various aspects of this year's version of our pension. Tamara started first met with us, I believe, in 2018, and every year that I've heard her speak, I've learned something new, and I'm certain that's going to be the case today. So thank you very much, and welcome. Frank Wolf, who is the person who found Tamara for us, is going to work on afterwards on handling questions that you may have that you would put into the chat. And Abdallah is going to mute us all after, so that we have this be as clean working as possible. So thank you.
Okay, well, Tamara, the floor is yours.
I was just going to say, the reason you learn something every year is the IRS changes rules every year. So we all learn something every year, let me tell you. And Frank, I didn't mean to interrupt you. Please go ahead.
I'm done.
Okay. So I want to talk about, as she said, the topic they gave me to talk about was changes to retirement plans and retirement planning and everything. But you know me, if you've been to any of the talks that I've done here, I like to keep you guys up to date on the estate tax laws. So I'm going to start with just the estate tax laws, and then we're going to get into retirement plan changes this year and changes from the years previous that have been changed again. And if you have any questions, please, this is your talk. You know, if I want you to understand any of these changes, please, Frank is going to man the chat box, and I'm more than happy to stop after every one of them and see if there are any questions, however you want. So let's talk about estate taxes and what's changed this year. The federal exemption this year is $12,920,000, and it's known as being portable. So if you're married, assets that you pass to each other during life pass both lifetime and gift time tax-free. That's called the unlimited marital deduction. The federal exemption I mentioned, that's effective 2023, of $12,920,000, is used when assets pass to someone other than a spouse. So it can be a friend, it can be a relative, it can be a child. whatever, but that is when the federal exemption comes into play. So portability is when the spouses can combine each of their federal exemptions, in this case, the 12,920,000. So portability allows a surviving spouse to pick up and use the unused federal exemption amount from the deceased spouse. As a result, the surviving spouse has both his or her federal exemption along with the unused exemption from the deceased spouse. So to give you an example of how the federal exemption works this year and how portability works specifically, you have a married couple, one spouse dies, everything goes to the surviving spouse. He or she has not used their federal exemption. So the surviving spouse not only has 12,920,000 of their own exemption, they have also the deceased spouse's 12,920, which basically means a married couple today, in just terms, simple terms, a married couple today that elects portability could pass $25,840,000, $25,840,000 federal estate tax free. Anything over that is going to be taxed at 40%. So portability isn't automatic, and I want you to understand how it works. To claim the benefit of portability of the federal exemption, the deceased spouse's executor or personal representative has to file a IRS Form 706. That's an estate tax return, to make the election to add the unused federal exemption to the surviving spouse's exemption. Even if a tax isn't owed, which in most cases it probably won't be, given the large size of the exemptions, you still have to file a 706, an estate tax return. Now, previously, this election had to be made within 2 years of the person's passing. Because a lot of people missed that, the IRS realized that was happening. In 2022, they changed that to 5 years. So the surviving spouse has, or the executor of the deceased spouse, has 5 years from date of death to file for portability. So that's the exemption amount. That's the exemption amount in 2023. As you know, we're already in October. So what Bloomberg Tax does every year is they come out with a projection, and that, mind you, these are projections, a projection of what the exemptions are going to be, and the tax, all the tax changes are going to be in 2024. And surprisingly, they are really accurate in nailing this. But I wanted to go over, you can find these if you go to pro.bloombergtax.com/reports/2024 projected US tax rates. Or just type in the bar, Bloomberg Tax Project 2024 projected tax rates. And they have a whole booklet. They'll give you what the projected, married couple filing status is going to be for income tax purposes. They have them all, but I'll just highlight two. They are projecting for next year, the federal exemption for each person will be $13,610,000. Now, that is a significant jump from this year. But again, we've had high inflation, and it's based on inflation. The other one that I wanted to go over was the annual gifting amount that you can do to anyone. In 2023, this year, that's $17,000. You can give $17,000 to as many people as you want. No gift tax returns are needed to be filed. It's an annual exclusion, and you can do it year after year after year. Bloomberg's projecting that that will go up to $18,000 next year. That's just an FYI. Now, why I bring these to your attention is that I would be remiss if I didn't say that these larger exemptions, the federal exemption that, this year is almost 13 million and next year is going to be projected to be 13.6 million, a little over that. They are scheduled to sunset, which means they are scheduled to basically go back to where they were before this increase under the Tax Cut and Jobs Act at the end, December 31st, 2025. So it would be effective beginning in 2026. If they go back, they're going to probably be, the exemption will probably be half of where it is now. That's the guess that I have. But I wanted you to know that portability is important. And the reason I wanted to bring it up is once it's the exemption, a deceased spouse passes away and portability has been elected, it can't go back. So if someone passes away when the exemption is 12 million and the exemption goes down, the surviving spouse is still going to have that 12 million plus their exemption. So that's something important to note. And the other projected item I wanted to mention was the standard deduction. Many of you might take the standard deduction since we don't have many deductions anymore. For married couples, it's projected to be $29,200. This year it's $27,700. And for single filers, it's projected to be $14,600. So I did just want to mention those, but get the booklet. It's very thorough and it will give you a good idea as to what's coming down the road next year. Now, everything I've talked about has been federal. There are state taxes, as you all know, the tri-state area. In New York, the exemption this year is $6,580,000, and it is not portable. New York is notorious for not giving the 2024, the next year numbers until late in the year, so I don't have a guesstimate of what that might be. Connecticut's is tied to federal, so Connecticut's exemption amount this year is $12,920,000, and New Jersey doesn't have an estate tax. They do have an inheritance tax, and an inheritance tax is based on who inherits and their relationship to the deceased. Now, I know everyone on this call probably isn't just from the tri-state area. Other exemptions, other states in the DC that have state taxes are Hawaii, Illinois, Maine, Maryland, Massachusetts, Minnesota, Oregon, Rhode Island, Vermont, the state of Washington, and Washington, DC. If you want specifics about what their exemptions are, just raise your hand. I'll give them to you. The one I did want to point out is Massachusetts, or Taxachusetts, as some people call it. Massachusetts is notorious for having the lowest exemption, along with the state of, I think it's Oregon. Both of them have a $1 million exemption. Massachusetts House of Representatives, I think it was last week, if I'm not mistaken, just voted to raise their state exemption to $2 million. So if that passes through, that would be a big, leap. It would double what the exemption is in Massachusetts. Any questions on any of those before I move on to retirement? None. If you have any later, just raise your hand. Okay, now let's move on to what's been going on with the enhancements to retirement plans. And I wanted to begin with a short recap of the Secure Act. The Secure Act, as you probably, I'm sure you remember, I told you last year, it stands for Setting Every Community Up for Retirement Enhancement. So the acronym is SECURE. And it was enacted on January 1st, 2020. Everything in the Secure Act was effective January 1st, 2020. So I want to go over some highlights because they carry over into Secure 2.0, which was the one that just was enacted. So the highlights on that act were that they raised the age that individuals had to start taking required minimum distributions from 70 and a half to age 72. They made changes to who could contribute to IRAs. Prior to the Secure Act, you could not contribute to IRAs, traditional IRAs, Roth IRAs, anything, once you hit age 70 and a half. The Secure Act said, we don't care what age you are. If you have earned income, you can contribute to an IRA no matter what age you are. They made permanent qualified charitable distributions. Now, qualified, just to remind you, qualified charitable distributions, first of all, you have to be age 70 and a half to do a qualified charitable distribution. And as a reminder, what a qualified charitable distribution is you can offset up to $100,000 of your required minimum distribution from your IRA and direct it to go directly to a charity. And the benefit of doing that is the amount that goes to the charity is not included in your income, but you don't get a deduction for it. So why would anyone do it? Reason people do this is it reduces your taxable income. So for example, if your IRA required minimum distribution from your IRA is $50,000 and you do a $50,000 QCD, that wipes out the taxability of your required minimum distribution. It may impact what your premiums are for Medicare in the future, because that's how they calculate what your premiums are. And it may reduce the taxability of your Social Security benefits. So there are reasons to do it, but the main, and I think one of the main reasons is many of you aren't itemizing anymore. And this is a way of getting kind of a deduction for charitable contributions without itemizing, because it directly reduces your income. So they made that permanent. It was in effect prior to the Secure Act, but it always had to be voted on by Congress because it was always expiring. This one made it permanent. And it will increase with inflation starting in 2024. That was part of the Secure 2.0 Act. And I think Bloomberg projected it to be $105,000 that year, but I'm pretty sure that's what it is. But again, that's a projection. So the biggest thing that came from the Secure Act was the 10-year distribution rule. And I think all of you are familiar with this, but I'm just going to go over it quickly. When a spouse dies and leaves a retirement account to their surviving spouse, the surviving spouse can just roll it over into their own IRA and take it over their life expectancy. You have to take and start taking required minimum distributions at the age they have to take required minimum distributions. When under the old rules before Secure Act, when a non-spouse inherited an IRA, they too could roll it over. So a child, for example, a friend, for example, they could roll it over into their own IRA. They had to start taking out required minimum distributions immediately, but they could stretch it out over their life expectancy. Along comes the Secure Act, and the Secure Act said, no, can't do that anymore for non-eligible designated beneficiaries. So they created a new terminology for beneficiaries. They're eligible designated beneficiaries. Those are the ones that can still stretch the IRA despite this 10-year rule. And an eligible designated beneficiary under the Secure Act is the spouse, is a minor child until they reach the age of majority, and a minor is considered to be reaching the age of majority at 18, a disabled individual, a chronically ill individual, and an individual who's not more than 10 years younger than the deceased. So that would apply probably most often to siblings. If you leave something to a sibling and they're not more than 10 years younger, they can still stretch the IRA despite this rule. So for anyone else, and most likely I'm just going to use the example of a child, instead of being able to stretch it out over their life expectancy, they have to take it out within 10 years. And now what I tell people, it's not just estate planning, because you all have a lot of retirement accounts, I'm sure. That's basically a lot of your wealth is in retirement accounts. It's not just estate planning anymore. It's income tax planning, both for yourself, but also for your beneficiaries. So we'll get into that a little bit later, but I wanted to kind of recap the Secure Act. So now let's go into Secure 2.0. So Secure, but did anybody have any questions about that before I go on? With a 10-year rule, with age, when you have to start taking required minimum distribution, that kind of was all in effect prior to the Secure 2.0. Okay? Okay. So now let's go into, fast forward into December 29th, 2022, when President Biden signed into law the Appropriations Act that carved out a package of retirement savings provisions known as Secure 2.0. So Secure 2.0 has over 90 provisions. Some people say there's 100. I'm going to go through every one in detail today. No, I'm teasing. I'm not going to do that. But I'm going to highlight the ones I think are most important for you. But it is voluminous. I mean, it's like 90 to 100 provisions. A lot of them are for plan sponsors, but a lot of them do affect individuals. So I wanted to go over the ones that I think will affect the majority of you. And if you have any questions, I'm more than happy to answer anything in more detail. Where I'm going to go is with required minimum distribution changes. We had them with the Secure Act. There's more with Secure 2.0. There's increased savings for individuals in this act. There's an expansion of the qualified charitable distributions that I talked about under the Secure Act. And now there's flexibility with 529 plan, college savings plan. So those are the ones I'm going to highlight and talk about a few other ones for you. So before I start, one thing I want to warn you about Secure 2.0 is the enactment dates are all over the place. I mentioned with the Secure Act, January 1st, everything that was in that act changed on January 1st, 2020. With Secure 2.0, some are effective this year, some are effective next year, some are effective actually 4 years from now. So when I talk about a change, I'm going to give you the enactment date And even some of these enactment dates have changed from when they were put into Secure 2.0 and now. So I'm going to go over all of those with you so that you realize, when these things are going to be effective. So let's get started. First one's with RMD changes, required minimum distribution changes. I talked about it with Secure. They raised the age that an individual has to start taking required minimum distributions from 70.5 to 70. Secure 2.0 changes this again. They changed it this year. Anyone that turned 73 this year is required to take out required minimum distributions. So everything was delayed to the start of required minimum distributions in 2023 is age 73. Then it goes up to age 75 in 2033. So there's two changes to when people or individuals are going to have to start taking RMDs. The first one was age 73 in 2023. The next one is age 75 in 2033. So you're probably saying, why didn't they just change it to 75 in 2033? And the reason is money. It's definitely money. I mean, if they delay these required minimum distributions, people aren't paying taxes. And if you continue working, you're not subject to required minimum distributions. You do know that. If you have earned income, you do not have to take out required minimum distributions. But this is for retirees, then they have to start taking out required minimum distribution. The question I get a lot from individuals is this good or bad? And I think it depends. I mean, the good part about it is if you don't have to take it out, the money's going to defer tax-free for a longer period of time. I also think it gives you a chance to do some planning. If you want to start converting some of your traditional IRAs to Roth IRAs, for example, if you wait until required minimum distribution time, you have to take the RMD out and then convert the rest. If you have this gap until you have to start taking it out, you can convert the entire amount that you want to convert without having to take out an RMD. So that's the good part about doing it. I won't say bad, but the challenging part about this deferral is I think a lot of individuals forget that the longer you defer, hopefully the more the IRA increases, but the factor that the IRS uses to calculate what your RMD is also increases. So as you get older, the percentage of what you have to take out increases. So you may be putting yourself, by deferring, you may be putting yourself in a much higher tax bracket than you needed to do if you would have started taking out smaller amounts earlier than you necessarily would have had to. So, you really have to work with your tax advisor or accountant to see if, deferring is the thing to do from your tax perspective and your income tax situation, or should you be, bringing in some income? And that can be by converting to Roth IRAs. That's a way of bringing in income. So I wanted you to be aware of it, that they keep changing it, they keep moving it. And the reason they keep moving it is people are living longer. So I think that makes sense that they are doing it. But I do think it isn't just an estate tax issue. Now it becomes an estate and an income issue. And don't forget, your beneficiaries, if they're not an eligible designated beneficiary, so they're a child, for example, they're going to have to take it out within 10 years. So if you're leaving a large amount of retirement assets to them, that's going to, again, it's a nice problem to have, but it is an issue. They're going to be subject to income taxation if it's not a Roth IRA that they have. Okay, Second thing that may be of interest is Roth accounts under 403B plans, 401k plans, and 457 plans no longer will be subject to RMD rules. There was always a difference between Roth employer plans and Roth IRAs. Roth IRAs didn't have an RMD, whereas Roth employer plans, when you reached required minimum distribution age, they had to pay out. So this kind of puts Roth accounts, employer accounts, on par with Roth IRAs with respect to RMDs. So I thought that might be an important point for you. And also the excise tax penalty, and again, I don't think any of you will be subject to this, but there is an excise tax if you don't take out your RMD when you have to. And it was really onerous. It was 50% of what you were supposed to take out, which was kind of ridiculous. And if anybody ever did it, and I only knew one person that did, if you wrote the IRS a nice letter and you said, gee, I forgot to do it, I didn't mean to do it, they waived it. So it was always this kind of, rule that really was never enforced. What Secure 2.0 did is, first of all, they reduced the penalty to 25%. And if you make a good faith effort to change it because you realize you didn't do it, the penalty gets further reduced to 10%. So I'm not quite sure why they did this, but I'm thinking they may start enforcing it more, because the 50% was never enforced. Again, anybody I ever talked to, any accountant I ever talked to, you wrote them a letter and they said, okay. But I'm thinking as a revenue generator, maybe they're going to be enforcing this more. So it's more just an FYI that I brought it up.
Tamara,
Okay.
there are a couple of questions that have come up of the previous topic. Do you want to wait till you're through to this sequence?
No, go ahead. Go ahead.
One was, can a qualified charitable deduction from an IRA be sent to a donor-advised fund rather than directly?
No, and that's a very good question. It has to be a public charity. And even though a donor advised fund is a public charity, for some reason, they do not allow QCDs to go to donor advised funds. And I have to tell you, it's a very good question. There are a lot of accountants and people that are lobbying to allow it to go to donor advised funds, but it's a good question. No, it cannot go.
And the second question, I think, is, well, I'll just let us say it. Are RMD funds from a 403B eligible for qualified charitable deduction?
No, it has to come from an IRA. That is, and again, it's a silly rule because it's the same thing. It's going to be taxed either way, but you can only make a qualified charitable distribution from an IRA. It's limited to $100,000 plus inflation next year. It has to be to a public charity, but donor advised funds don't qualify, private foundations don't qualify, etc.
Thank you.
Anything else? Nope. Okay. The one thing I wanted to mention, and this wasn't with the Secure Act, but one of the reasons I went back and talked about this 10-year rule is it garnered tons of responses from accountants, tax attorneys, individuals, because no one knew that these beneficiaries had to take out RMDs based on it. Let me backtrack. First of all, what happened is the Secure Act did this 10-year rule, and this is back in 2020. The IRS actually waits 2 years to issue proposed regulations to tell us how to interpret this 10-year rule. And the way they interpreted the rule was how no one interpreted the rule. So the IRS comes up with proposed regs in February 2022 and says, listen, you guys have all been interpreting this wrong. If the beneficiary, so again, I'm going to use a child in this example. If a child inherits from someone, let's just say the father or mother, who was age 65, and they weren't subject to RMD, so they weren't old enough, or they weren't of age where they were required to take out minimum distributions, then you're right. The child inheriting it can roll it over and can take it out at any time during that 10-year period. They can take some out in the first year for a down payment on the house, not take anything for 2 years, take it out again in year 4, don't take anything out, but by year 10, they have to deplete the IRA. However, if the person that they inherited it from was already required minimum distribution age, again, let's say it was a mother who was age 75, clearly taking out required minimum distributions for 3 years, 4 years, whatever it was. When the child inherited the IRA, they were supposed to take out required minimum distributions in years 1 through 9. Based on their single life expectancy, they can always take out more, but they had to take it out over their single life expectancy in years 1 through 9, pay taxes on that, and then by year 10, deplete the whole IRA. Well, no one knew this. Absolutely no one knew that this was the requirement. So this caused quite a stir, because people didn't know, okay, if I didn't take it, if the person didn't take it out, or I didn't tell someone to take it out as an accountant, are they going to be subject to penalty? Don't forget, not taking out required minimum distributions was subject to a 50% penalty. Now, if they didn't take it out, do they have to take the remaining amount over 9 years, over 10 years? What's the rules? So the IRS goes, uh-oh, we're in trouble. Nobody knows what to do. We're not sure what to do. So we're going to kick the can down the road. So they issued a notice at the end of 2022 saying, oops, we know you didn't know how to do this. We know you weren't aware of doing this. So there's no penalty for any of these beneficiaries that didn't take it out in either 21 or 22. Because if someone, this only applied to decedents of IRAs starting in 2020, where the beneficiary would have had to start taking out required minimum distributions in 21 and 22. So anyone that was subject to these, we're kicking the can down the road. We're going to explain the rules and how they're going to go forward, but no penalties, which means if there's no penalties, people don't have to take it out. Fast forward to 2023. We still got nothing, nada from the IRS. So what does the IRS do? They issued another notice. They recently, in August, and they said, okay, people that had to take it out in 2023, no penalty. The earliest we're going to rule on this is 2024. So I do get questions about this. So I just wanted you to be aware, if you are one of these beneficiaries or know somebody that is subject to these nebulous rules that nobody knew about but now apply, if they didn't take out any RMDs based on their own life expectancy in either 21, 22, or 23, there's no penalty. They didn't have to take it. Now, the caveat to that is if they did take a distribution out during those 3 years, not necessarily as a required minimum distribution, but because they needed money, they can't go back and put the money back in. They said once it's taken out, it's taken out. But if you didn't take it out, you don't have to take it out, and there's no penalty. So I just wanted you, and we're supposed to get, regulations on, final regulations on this next year. I say don't hold your breath, but that's supposedly when it's going to happen. But I did want to bring that to your attention. So Secure 2.0 increase savings for individuals in a lot of different ways. First of all, higher retirement plan catch-up limits will apply starting in 2025. So this doesn't start until 2025 for individuals who are age 60, 61, 62, or 63. It's just those groups, those ages. Currently, individuals over age 50 can contribute an additional $7,500 to employer-sponsored plans. Starting in 2025, that amount is going to increase to the greater of $10,000 or 50% more than the regular catch-up contribution. And again, that only applies for people age 60, 61, 62, and 63. So that's one thing that increased for individuals. Secure 2.0 also increase the IRA catch-up contribution amount for individuals over the age of 50 for cost of living beginning next year. Thank goodness. It's been that same $1,000 for 15, 16 years. So that $1,000 is supposed to catch up for a regular IRA contribution is supposed to be increased for inflation beginning in 2024. So stay tuned for that. And lastly, under current law, catch-up contributions to qualified retirement accounts can be made either pre-tax or post-tax, which would be, on a Roth basis. For tax years beginning in 2024, so next year, all catch-up contributions to qualified retirement plans are subject to Roth tax treatment unless you earn under $145,000. Now, that being said, the IRS just punted this one also. This one got a lot of pushback from institutions because the institution said, hey, on a dime, because this is a 2023 Tax Act, right? On a dime, we can't just add a Roth plan to our plans if they didn't have them. So the IRS just ruled in August that it's still going to be effective in 2024. However, institutions have until 2026 to implement this. So what does this mean? It means that, again, they're punting it down the road. So if your plan doesn't have a Roth component to it, that the plan sponsor is going to have 2 years to get a Roth in. What I don't know, and I don't think it's going to happen, but what I don't know is if your plan does have a Roth, are they going to mandate that this be in your catch-ups be in Roth? And I tend to think no, because the plans are going to have to notify individuals, participants about this. So I think kicking it down the road and not enforcing it until 2026 is going to give plan sponsors that leeway to determine when this gets implemented. The $145,000 has a lot of caveats to it. I just want to go over with you. First of all, the $145,000 has to be wages. So you have to be an employee. And I bring that up because if you're self-employed, if you're a partner in a business, you're not making wages. You're making other income. So you're not going to be subject to this. It has to be based on your previous year's employment, and the wages have to be from the same employer. So if you switch jobs, so for example, if this was effective next year, and if this year you had 2 different employers and had wages of $150,000 that year in 2023, you wouldn't be subject to this. It has to be from the same employers. And I guess that's it. The only other thing is simple IRA plans aren't affected by this because they're not considered qualified plans. So I just wanted to go over that. That's kind of important, but again, it's kicked the can down the road, but it will be effective in 2026 or enforced. It's effective in 2024. It's enforced in 2026. And I also wanted to go and talk about the expansion of qualified charitable distributions. So we talked about the $100,000 limit, the fact that it's going to be adjusted for inflation in future years. They added something in Secure 2.0, which is interesting. I'm not sure how many of you are going to take advantage of it, but what they added was they said out of that $100,000, you can carve out $50,000 and contribute it to a charitable remainder trust or a qualified charitable gift annuity. And let me talk about the specific. It's not in addition to the $100,000. It's part of the $100,000. So if you did this and you contributed to a charitable remainder trust, what a charitable remainder trust is, if you're not familiar, in a nutshell, is you contribute money to a charitable remainder trust. It's called a split interest gift because you retain an income interest in whatever you contributed to the charity. And when you pass away or a term of years, whatever remains in that goes to the charity. So the way a charitable remainder trust works is, as I said, it can be for a lifetime, or it can be for a term of years up to 20 years. So what would happen is, remember, this is coming from an IRA. So if you contributed a $50,000 to a separate charitable remainder trust, you can't add to one if you already have one. It has to be separate. What would happen is, let's just say you did it for your lifetime. The IRS calculates what your annuity is going to be. It has to be at least 5%. It can go up to 50%, but it's based on what the interest rates are at the time that you contribute it and what your life expectancy is. So it's an IRS calculation. You have no control over it. So you contribute $50,000 to a charitable remainder trust. You get to keep a 5% interest, let's just say. That 5% interest that you keep for your lifetime is going to be totally, entirely subject to income tax because it's coming from an IRA. And at the end of the term, whatever's left, or when, I shouldn't say term, when you pass away, whatever's left goes to charity. That's a charitable remainder trust. I can't imagine anyone is going to do this because you really have to go to an attorney to have a charitable remainder trust drafted. It's probably going to cost you more than the benefit you're going to get from this, but it is available to you, and it has to be on your single life. I can see more people doing the gift annuity because that's actually done by a university, a college. They have these, every institution has one of these. So what you would do is you can contribute $50,000 to it, and you can also do it with a spouse. So you can do a joint one there. So that would be $100,000. They calculate the annuity. It's going to be taxed at ordinary income. And at the end, if you do a joint, at the end of the survivor review, whatever's left goes to charity. I think this is going to appeal to people who are charitably inclined but really can't afford to be. They can't give up the asset. They can't give up the income from the asset. So I think it's going to have limited availability, but it will be increased for inflation. So maybe a little bit down the road, it may make some sense to do it. Caveats to this is the $50,000 has to be done in one tax year, and it can only be done once in your lifetime. So if you contribute to a charitable gift annuity, $30,000 in January, you have until December to add another $20,000 to that to get you up to the 50. If you don't do it by year end, you're stuck with $30,000. Other than that, I think with the charitable gift annuity, it may make some sense. You have to be 70 and a half, but you knew that because you have to be 70 and a half with to do a qualified charitable distribution in general.
We have a couple of questions when you're ready.
Okay, I'm ready.
This is about conversion of Roth account to Roth accounts. How does one determine if conversion to a Roth account is cost effective given the immediacy of the tax bite?
What I always tell people, and if you live in New York City, it's a tough one. It really is, because you're not only subject to federal, you're subject to state. And if you're in the city, then you're subject to city tax. But the way I always discuss this with individuals is, if you can bring income, additional income into the tax year without putting you over into the next tax bracket, it might make sense to do, because you're not increasing your tax bracket by doing it. You're just filling up the bucket until you reach, the highest level of your tax bracket. So to me, that's one way of looking at, is it tax effective? If I'm going to pay the same amount of taxes, maybe I'll bring in an extra 10,000, 15,000 of income this year, convert it to a Roth. And then the advantage to you is you don't have to take out distributions from it during, you don't have RMDs from it. So that could be an advantage for you. And if you have a spouse, that could be an advantage for the spouse also. And it's a big advantage to your beneficiaries because they don't have to take it out. And again, with the squashed 10-year rule, that's a big advantage for the beneficiaries also. So if by converting some of the traditional IRA into a Roth IRA, and you're not increasing your tax bracket, then I think it does make some sense, because in the long run, you're going to benefit from not having to take out RMDs.
Second question, does the 12/31/25 sunset apply to allowed annual gifting amount as well as the estate tax exemption?
No, it's just for the only thing that doubled under the tax what was it, Tax Act and Tax Cuts and Job Act was the federal exemption. That doubled. Right. The other things did not. The annual exclusion did not double. So that will make sense.
One other question, can you use the CQA to multiple institutions or only to one?
Nope, you can give as many institutions as you want. It's a wonderful thing to do. It really is. So the plan sponsor may have limits as to how many. They may have limits as to the minimum amount you can give to an institution. But in general, you can give to 25 institutions, as many as you want.
Okay, we're up to date on questions.
Okay, and the only other thing I wanted to talk about was 529 college plans, savings plans. I mentioned those briefly last time, and there were a lot of questions on those. And just to remind everyone, 529 college plans, they're sort of like IRAs in the respect that you can contribute, but they're better than IRAs. You can contribute your annual exclusion amount, the $17,000, to a 529 plan, and it has to be used for education purposes. When it started out, and this is a while ago, it was only for higher education. And then I think in 2017, K through 12 was added, so you can use contributions to that for tuition in K through 12. And then in 2019, apprenticeships were added to it also. But in a nutshell, a 529 plan is you contribute to a 529 plan, which is run by every state. Every state has one. Different sponsors are with, various sponsors are with the states. And basically what happens is those contributions defer income tax free, which is great. That's a great thing. And if you use the monies for education purposes, it comes out tax free. So it's the best of all worlds. You put it in, it defers tax free, and if it's used for education purposes, it comes out tax free. And there's various ways you do it. You can either direct the 529 plan to pay your, for example, the college tuition directly, or you can pay it and then submit the receipt to the 529 plan, and they will reimburse the beneficiary. You have to realize that you're making gifts. So this is the beneficiary's money. So if it's, $50,000, you may want to have them do it directly rather than reimburse the beneficiary. But it's the best of all worlds. So what they did was, a lot of people liked it, but didn't, and you can contribute, before I get on to the changes, you can contribute up to 5 years worth of annual gifting at one time. So in 2023, you can contribute $85,000 in 1 year. That's going to be your next 5 years of gifting, but that gets the deferred growth going if you wanted to do that. You don't have to file a gift tax return or anything. So a lot of people liked the idea, but they said, well, my son is just a fantastic athlete and wonder if he gets a full scholarship. Then I don't need that money. Well, what you can do actually with 529 is you can pass it down to someone else. You can pass it down to a sibling. So, there is some flexibility in it, but people were not fully funding them because they said, well, maybe I won't use it. And if what you can do is take the money back, but you're going to pay a 10% penalty and income taxes. So you don't really want to do that. So what the IRS came up with, which I think is it's not a great, but they said, if you have leftover money in a 529, you're allowed to take some of that money and contribute it to a Roth IRA for the beneficiary, which is kind of a nice thing, right? Because that defers the taxation for the beneficiary's benefit. There's a lot of guardrails around this, though. It has, first of all, it has to be the same beneficiary of the 529 plan. It has to be in existence. The 529 plan has to be in existence for at least 15 years. Contributions made within the last 5 years do not count. You can't use those to fund a Roth IRA. And the maximum amount that you can contribute to a Roth IRA is $35,000. So it sounds great, but there's a lot of guardrails on this. A lot of questions too, and I think the IRS is going to have to come out with rules on this, because this is actually effective next year, and we still don't know exactly how it's going to work. Because one of the questions is, as I said, you can pass a 529 plan down to a sibling. Well, does that start the 15-year rule starting again requirement, or do you tack on the requirement? That's one of the questions that is lingering over this. But it does make sense. I mean, it's a nice that they're doing it. You're still subject to the same Roth IRA contributions limits that you are with regularly contributing to a Roth IRA. But they are giving you or someone an outlet for what to do with excess 529 contributions. And that's really all I had to talk about. But if anybody has any questions, or if I can answer any questions for you, I will be more than happy to. And if and when the IRS comes out with what the exact inflation adjusted 2024 numbers are, I will shoot them to Frank and Abdullah so that you have them and they can just distribute them to everyone.
I have one question. I have one question. There are none in the chat, but as I ask my question, if you have questions, please put them in the chat. My question is not for myself. It's for people who are recent retirees. They will discover their premiums for Medicare Medicare supplement plan, no, for Medicare Part B and Part D may have income-related adjustments to their premiums. However, if you have your income goes down, and they base that on 2 years previous tax return.
Yeah.
But if your income goes down precipitously as a result of retirement or termination or whatever it is, you can file a document with the Social Security Administration to reduce your premium. The question I have is, if you don't do that, when 2 years down the road, it's clear that you were charged too much, do you get it back, or do you have to do that only in advance?
I don't know. That's a good question, Frank. I will, I'll look it up. I would assume, and again, you know what happens when you assume. I would assume you can get it back, but I don't know the procedure for doing it. But let me look it up and I'll get it for you.
The reason I ask is because I did this when I lost my when I finally retired, after long after I left Columbia, and I did go through the process, but it was very cumbersome to file that application. And I know I'm going to have to do it again this year. But if I knew that it's just a question of getting the money now rather than later, I might not bother. You see what I'm saying?
Yeah, I know. Dealing with the Social Security in general is never pleasant. I'm going to look. I do have a contact there, but and I will ask, but I'm going to look online too to see if there's any kind of provisions online, because I know they've stepped up their online presence. So I'll look there too. But it's a good question, and I will get back to you. I promise.
We have one other question. Thank you.
Okay.
Can a 529 be used for grandchildren?
Yeah, yeah. And in fact, that's what, if what you're saying, you can fund a grandchild's 529. And the benefit of doing that, and again, I don't know, maybe I'm getting into the weeds too much, is 529 plans contributed by parents to the children are going to affect their eligibility for, government assistance. Plans funded, 529 plans funded by grandparents do not until the child takes the money out. So there is a benefit for grandchildren to doing it. If your question is, can it be passed down from a child to a grandchild? The question is yes. The answer is yes, it can.
Okay, I think with, someone asks, where did you find the Social Security form? I think that's a question to me. SSA 44 is the answer, I think, online, Mr. Basuto. But if you want to just email me, fw5@Columbia, we can do that off the line.
Yeah, you can do it. It's just that's my assumption and where I was leaning, and it just, I bet you, is cumbersome to try to get money back. That's always cumbersome.
Right.
Anyway,
Well,
thank you for having me.
I have one question. I'm almost embarrassed at how ignorant I am of all this. But if you have all these requirements for taking out, you have it's $25 million free estate, and then you have money in your pension that your child will inherit. Why isn't that just part of your estate or not?
Yes, it is. Your estate consists of non-qualified assets, bank accounts, house, everything. It also includes your retirement accounts. Yeah.
So why wouldn't your kid just take out, if assuming your pension is less than $25 million, why wouldn't your child just simply take out that money tax-free and do whatever it wanted, he or she wanted to do with it?
Well, it's federal estate tax free. It's not income tax free. I'm talking about income tax. Does that make sense? Yeah, there's two different taxes, and I apologize if I didn't make it. Yeah, them getting the money is federal estate tax free for most of us. With none of us, or I should say none. I don't know all of you. I don't have a $25 million estate, so my retirement accounts are going to go to the children federal estate tax free, but then they have built up income taxes in them because I didn't convert anything to a Roth. So they have to pay income taxes over 10 years. And I have big retirement accounts, right? So they're going to be probably in a higher tax bracket than they normally would have had to if they just keep deferring it until the last year. If that's why there's tax planning that goes on.
So you really, if you have a lot of money in your tax and you've lived a frugal life and intend to continue, you should try to convert that to.
Yeah, that's actually no, but there's both sides to this story. All of you probably have large retirement accounts. I mean, it's just the nature of the benefits that you get, and the question becomes, not that you don't contribute to them because they're good, but should you start taking out money before you have to? That's really the dilemma now, because it was always defer, because my kids can defer, or my beneficiaries can defer. And, it's like you're giving them a pension plan. But now when they have to take it out within 10 years, is that still the best thing to do? Or do you start whittling that down and leave them more of the bank accounts, the stocks that you own, at the house that you own, because they're going to receive those assets with a stepped up basis. So you bought your house, and I get this all the time. Everyone that lives in New York City, 50, 60 years ago bought their apartment for $60,000. And at the time that was expensive. And now it's worth $2 million. So you can't sell it. You're going to pay capital gain. But when your children inherit that at your passing, they inherited at $2 million. So they don't have to pay that big capital gain. So it's better for them to inherit those kind of assets than retirement assets, because the retirement assets have built up income taxes. So, I mean, in a perfect world, that's what you would do. But, you're my primary people I want to make sure that are taken care of. It's nice, but it's something to think about, because now you don't have that stretch and give your children that pension.
Well,
all right.
That should be the worst problem that all of us have, right?
It's a nice problem. I always say that it's a very nice problem to have, but it is something that you have to think about. But anyway, thank you. It's always
so much.
Thank
And
it's always great talking to all of
we're
you.
one of the assets of EPIC, and we are so happy that you come to talk to us each year.
But you always say
very
you learn
generous
something,
of you.
and that's
Yeah.
why. The laws are always changing. I'm always going to be teaching you something. Anyway, thank you.
One last question, Laurie Mark. If the asset is owned in a trust, does the basis still get stepped up?
It depends, right? The answer to everything is it depends. If it's an irrevocable trust, the answer is no. If it's an irrevocable trust that's a grantor trust, the answer is yes. If it is a revocable trust, which many of you may own, the answer is yes. So a grantor trust is a trust that you make an irrevocable gift to, but you did something to the trust, so you're still paying income taxes on it. So it's not included in your estate, but you get the step up in basis. If it's a normal irrevocable trust, like a life insurance trust doesn't matter because you're getting a death benefit. But like a trust that was formed when a spouse passed away, often called a credit shelter trust, a bypass trust, a family trust, those do not get a step up in basis.
All right, thank you very much, and we hope to see everybody at Lindsay Gallen's talk next Tuesday, and mark your calendars for a wonderful concert from the classical music performance in February. It's all in the newsletter. Thank you, and bye-bye.